If you're over 45, earning more than you ever have, but still feel a quiet financial pressure you can't fully explain, this may be the reason. On paper, you're successful. Your income is strong. Your career is established. Your lifestyle reflects decades of effort. But beneath that stability, there's tension. A subtle awareness that if something unexpected happened, a job disruption, a health issue, a market downturn, things could tighten faster than you'd like. That feeling isn't irrational. And it's not a discipline failure. It's structural. In your 20s and 30s, financial inefficiencies are inconvenient. In your 50s, they are expensive. Time compresses. Healthcare costs rise. Retirement approaches. Energy and risk tolerance shift. You no longer have decades to recover slowly. And here's the surprising reality. Many households earning well into six figures still report living paycheck to paycheck. Income has grown, but flexibility hasn't. And flexibility, not income, determines security. Consider a 53-year-old professional earning $180,000 a year. Nice home. 2 vehicles. Annual travel. College tuition support. From the outside, everything appears solid. But if income stopped for 6 months, pressure would begin quickly. Not because of irresponsible spending, because of permanent commitments. The real problem isn't overspending. It's fixed expansion. Raises increase income. Upgrades increase obligations. Obligations reduce margin. And after 45, margin matters more than income. Most advice tells you to earn more. But after midlife, the strategy changes. It becomes less about acceleration and more about insulation. There are 4 quiet traps that create this pressure. The first is reward drift. After decades of work, upgrades feel justified. A better car. A renovated kitchen. More convenience. More comfort. Emotionally, that makes sense. But when rewards become recurring costs, flexibility shrinks. The second trap is the upgrade cascade. A better job leads to a better neighborhood. A better neighborhood leads to higher expectations. Higher expectations create higher fixed costs. Each step seems logical in isolation. Together, they permanently elevate your financial baseline. And baselines are hard to lower without discomfort. The third trap is social benchmarking. As income rises, your peer group changes. Spending becomes subtle signaling. Vacations imply success. Homes reflect status. Experiences communicate identity. But wealth is rarely built through comparison. It's built through retained ownership. The only reliable way to win the comparison game is to quietly stop playing it. The fourth trap is confusing income with wealth. Income is flow. Wealth is stored capacity. You can earn $200,000 per year and still build limited net worth if most of it flows directly into fixed commitments. High income without retained assets creates dependency. Dependency creates fragility. Here's a simple diagnostic question. If your income stopped tomorrow, how long before stress begins? 3 months? 6 months? Immediately? That number matters more than your salary. Because security isn't determined by what you earn. It's determined by what you control. The solution isn't extreme frugality. It isn't cutting every small pleasure. It's structural correction. Here's a practical 5-step framework to convert income into durability. Step 1. Freeze lifestyle escalation. For the next 24 months, avoid adding new permanent obligations tied to income increases. No larger mortgage because of a raise. No new recurring financial commitments simply because earnings improved. Temporary enjoyment is fine. Permanent pressure deserves caution. Step 2. Automatically redirect raises. Commit at least half of every income increase directly into asset ownership. Before you see it. Before you adjust your spending. Income growth must convert into asset growth.
Otherwise, you're simply expanding your cost structure. Step 3. Audit your fixed expense ratio. If 65 to 70% or more of your income is locked into housing, vehicles, debt payments, insurance, and other fixed costs, your flexibility is thin.
Small discretionary spending rarely creates financial stress. Structural rigidity does. Step 4. Track net worth quarterly. Not daily portfolio movements. Quarterly direction. Total assets. Total liabilities. Net ownership. When your focus shifts from income to ownership, behavior changes.
Measurement creates awareness.
Awareness creates discipline. Step 5. Define your resilience number. Not your dream retirement target. Your 12 to 24 month survival number.
The amount of liquid and invested assets required to operate without income for at least a year.
That number creates psychological stability.
And psychological stability improves long-term decisions. Behavioral finance research consistently shows that spending expands naturally with income unless intentionally constrained.
Wealth expands only when allocation is deliberate.
Historically, much of middle-class retirement wealth is accumulated between ages 45 and 60.
Not through extreme speculation.
Not through dramatic windfalls.
Through consistent allocation and structural discipline.
This stage of life isn't about chasing more.
It's about converting what you've built into resilience.
If this feels familiar, you are not behind beyond repair.
You are not careless.
You've simply allowed income growth to outpace structural control.
And that can be corrected. Imagine reaching 60 not wondering whether you can retire. Not calculating how many more years you have to work. But knowing you have options.
Lower fixed obligations. A growing base of assets. Reduced dependence on a single paycheck.
Not flashy. Not dramatic. Stable.
And at this stage of life, stability is real wealth.
High income feels powerful.
But controlled structure builds freedom.
And after 45,
freedom matters more than income.